Hello, everyone, and welcome to our webinar, Making Sense of the Budget. What do deferrals mean for school finance? We know this is an exceptionally busy day for those of you in public education. Most of you are probably aware about the governor's announcement, which means that the vast majority of California public school students will begin the 2021 school year with distance learning. That has a number of implications in terms of academics, in terms of support, and of course, in terms of finance. Many of the same concerns that predated the governor's announcement exist today, and there are also some new ones as districts look at how they will pay for costs related to distance learning for all students. Cash flow management is going to be at a premium as districts deal with an unprecedented number of deferrals. And the best way to approach that is the topic of today's presentation. Before we dive into that subject a little more deeply, we want to go over some housekeeping details. Here's how you can participate in this event. We know many of you have specific questions you'd like to ask. We hope that you will reserve those questions until the end of the event after all our guests have presented. However, submit the questions now and we will present them to our guests at the end of this webinar. The way that you can submit your question is by using the module, which you should see in the top right-hand corner of your screen. It's primarily a light gray module with dark gray menu bars. Toward the bottom of the menu bars, there's one labeled questions, which has a triangle pointed to the right. Click on that triangle so it's facing downward and a text box will appear. Type your question into the box the same way as you would an email or a text message, and that question will be received behind the scenes by CSBA staff, and it will be logged for presentation at the end of the event when our guests will answer it. If we aren't able to get to your specific question, we will answer it after the event, either through a direct email or by posting it to the FAQ section on our coronavirus website. But we will make every effort to address every major subject area which is raised, even if we can't answer all the individual questions. But we want to make sure that every important topic related to cash flow management and specifically deferrals is addressed today. So with no further ado, let me introduce today's experts. Joining us today are Dennis Myers, the Assistant Executive Director for Governmental Relations here at the California School Boards Association, and also Mark Farrell, who's the Senior Financial Advisor at Dale Scott & Company, one of the foremost firms in dealing with issues like cash flow management and deferrals. I'm Troy Flint, the Chief Information Officer at CSBA, and I now give to you our Governmental Relations Head, Dennis Myers.
Thank you, Troy. And thank you, everybody, for tuning in. This is unprecedented times, and every webinar and webcast you've attended the last couple of months have said this is unprecedented. But little did we know in January that the May revision would have been what it was. Little did we know when the May revision happened that we would then have the legislature pass the budget that it did. And then little did we then know that the settlement of school finance and SB 98, almost as the fiscal year started to begin, would be what it contained. What we want to do today is really get you as the governance team thinking about cash flow. So when you've seen budget presentations, we've always talked about these massive numbers, 2.9 billion for this, 1.5 billion for that. But in this webinar, we want to get you thinking about what it means to you and your local educational agencies, school district, county office of education, what it means for you and how you're going to finance your expenditures from July 1, not only through June 30 to finish out this year, but you always have to be thinking the next fiscal year and the next fiscal year after that. So that's kind of how I want to set this up, is we're going to talk a little bit about what's in the budget, but a lot of bit about how it translates into your monthly cash flow. Because right now you're thinking of, you've already adopted your preliminary budget, So you are thinking of two things right now. You should be. One is, how are we going to reopen our schools? So we know that is first and foremost in your mind. We're having lots of conversations with you, so we know that that is the first thing. The governor's got some new pronouncements, some new guidance on that, so we know a lot of those conversations are going to really ramp up, even as high as they've been the last couple of weeks. That those decisions have to be made quickly by the school boards. The second thing, obviously, is how you're going to pay for some of these ramping up for reopening. You know, how do you do your PPE? How are you going to do adequate distance learning, things like that. And then you also, a part of that, have to think about cash flow. So let's get a little bit into kind of what's in the budget and what it means for you at the local level. Go in for the next slide, please. This slide is real similar to what we did in our budget workshop a couple of weeks ago. What we wanted to do here is just kind of get into your minds kind of where some of the cash is in this budget. So the legislature, you know, I'm pretty sure most of you, when you adopted your preliminary budgets, adopted it based on the May revision. So it was kind of the lowest common denominator at the time. Everyone felt confident that the budget would not get worse than that. And if you recall, that's the one that included this 10% cut. It was a 10% cut to the local control funding formula, 10% cut to everything in the formula, and then 10% cut to most of the categorical programs that are remaining. And so that kind of set the standard of, okay, things aren't going to get worse than this. And they got a lot better, but they got a lot better through some maneuvering. And so that's what we want to talk about today. So the starting point, so the thing I want to kind of get to is this first line where your budgets are starting with the zero COLA. But just to the right of this, we got to really talk about the state. The picture from the state level didn't change. So Prop 98 is still down almost $11 billion. And so the state is scoring that savings in this current fiscal year. So if you go Department of Finance and you look at their charts, you'll see that Prop 98, boom, goes down almost $11 billion into this budget. But your spending authority is right here. And this is what we want to talk about. Spending authority through the deferrals, and we're going to get to that in the next slide, is up here. It's actually almost $11 billion more than where the Prop 98 guarantee is. So it's an accounting maneuver done by the state to allow school districts to county offices and charter schools to spend at a higher level than what is otherwise provided for by Proposition 98. But starting at that zero COLA, the state then also said, well, we've got other things that we can do to actually free up or provide spendable cash in this current year. So Prop 98 had a drop. We're going to work on some deferrals, but then there's also a little bit of ongoing, but mostly a lot of one-time relief and one-time money in this budget, to allow some additional expenditures. The main expenditures, if you ask the governor, hey, are there additional resources to school districts and county offices? He's going to say, absolutely there is. We provided $5.5 billion in new money, and it's meant to increase services, to provide robust distance learning, to buy personal protective equipment. He's going to line out the expectations there, and those are real things that you need to consider. Okay, so let's move on. So we know deferrals we'll talk about, but where's the money in this budget? First of all, there is a state investment in special education of more than $600 million. The way this is allocated is to raise the base rate to no less than $625 per student. So this is a varied benefit to those your LEA, and it depends on where you were in 2019-2020 in your base rate. So if you have a special education base rate of $700, you're not playing in this money at all. But if you had a base rate of, let's say, maybe $575, then you're going to see an increase of about $50 per student on your special education AB 602 formula. The second piece of this was $100 million that was committed to low incidence disabilities costs. So some of you, wherever you are in your base rate, there are high cost services that you're providing. This $100 million is meant to provide some extra support for that. So the reason why we wanted to kind of start here is because this is the one place where it's state money and it's ongoing, and meaning that it's more predictable than the rest of what is on this slide. But again, the thing you need to know is that it's got a varied benefit depending on where you are as your individual local educational agency. The next one is the state then did in adopting the budget is they reduced the employer contribution rates to CalPERS and CalSTRS by about 2 percentage points. What they did is they took money that was set aside to pay down the unfunded liability and pulled that half of it, almost half of it, into this fiscal year and said, let's buy down the employer rate. Why this is important is because this isn't an increase to you, so they're softening that increase and actually reducing the employer contribution rate, freeing up money that would normally then be used to pay these rates. So it's like an increase in that it's freeing up cash and freeing up cash flow. So those 2 percentage points are based on about 80 to 90% of your budget. So you are about 80 to 90% people. That's where you're spending most of your revenue. So that equals about 1.6 or 1.8%. The previous bullet on special education, where I said it varies, the benefit varies. This benefit is across the board. Whether you're a county office or a school district, you are going to get this reduction, and it's in both your certificated staff, CalSTRS, and in your classified staff, CalPERS. Again, that's in this budget for this year. There's an expectation that this will continue into the next year. But that's somewhat, I'll say, we just need to make sure that happens. And so obviously, CSB and others will continue to make sure that happens because the money is there for the next fiscal year as well. Then comes the Federal CARES Act money. And what happened is the Federal CARES Act actually provided money to schools. Federal CARES Act actually sent money to the state that was discretionary. The governor came in and the legislature agreed to put more of the state share into K-12 schools, which is a good thing because it provides some assistance to you. So what we did is we outlined here the 4 places where the federal money is allocated. The first one, and in most other seminars, you'd see this $2.9 billion to all LEAs based on unduplicated students. Now, what does that mean to you locally? It's a varied benefit. It's not a per average daily attendance allocation. We couldn't just divide that $2.9 billion by 6 million students and say, hey, it's $490 per ADA. That's not how this works. It's based on your amount of unduplicated pupils. So if you have a high unduplicated count, let's say in the 80-90%, you're going to get more of this money than if you are a lower unduplicated count, let's say in the 10 to 15% range. So that money is going to vary based on that amount. The higher your unduplicated count, the higher percentage that this means to you. So you could see by local educational agency a variance of maybe $50, $80 kind of per pupil, all the way up to maybe $800 or $900 per pupil. Again, these we wanted you to know. We don't know yet exactly how this money gets allocated. That's being developed right now by the Department of Education. So we know that you and your fiscal staff are going to be looking constantly to your county office of education, to the Department of Education to find out what's this mean for my district, what's this mean for my county. But again, that is cash. It is from the federal government, and it's just for this fiscal year. The second part is this $1.5 billion going out per special education. So any district, any county office that gets special education money gets this. So again, it's got a varied benefit, but I'm going to say almost everyone is going to get this money, but again, it's going to be by a varied benefit. So again, we can't just divide by 6 million kids and say you're going to get the same amount per ADA. It's going to be a varied amount between 1 or 2% kind of an increase. Now here's one, this $980 million goes out per the LCFF formula. So this does not go into LCFF. So your LCFF entitlement that's calculated every year by the Department of Education is what's flat funded in this budget without the cut that was proposed in the May revision. This additional money then is allocated through that same method. So there's base grant, and then there's supplemental and concentration grants, same math. but it'll be in addition on top of your LCFF. The reason why that was done that way is, one, is it puts it out toward the formula so that LEAs can all benefit from it. The second thing is, the reason why it's kept out of the LCFF is because this is federal money. It is one-time money. And so it doesn't make sense to put that in the ongoing LCFF. So it was the safe way to do this. Again, this is worth about 1.8%, kind of on average, depending on what your unduplicated count is. But again, this gives you an idea of where some cash might be in your budgets this year. Lastly, if you recall, part of the CARES Act that was specifically to schools was the part that was based on Title I funding formula. So this is $1.5 billion to local educational agencies. This was not discretionary on the part of the state. This is what Congress said, and they allocated it to LEAs based on the Title I formula. And so this actually is about 70%. It's the equivalent of about 70% of your Title I formula. So as your school board members, whether or not you're a Title I district. What you also need to then ask your staff is, okay, what is this money worth us? What is our normal Title I annual allotment? It's been kind of flat the last few years, and then know that this is extra money, again, one time from the CARES Act, and it's got the equivalent of about 70%. So that's, if you add these up, that's where the conversation will be with your staff to be able to cover the cost of reopening, the cost of distance learning, things like that, into this next school year. Next slide, please. The next thing we want to talk about then are the deferrals, because these deferrals, while we've done them before, so if you've been a school board member, more than 10 years, you've lived through the last round of deferrals. But if you did live through that last round of deferrals, that last round was done over time. This is a precipitous boom, a lot of deferrals all at one time. And so that's why these are specifically challenging. So you probably did not even know that there was a deferral that already happened. So there was a deferral from the last fiscal year, from June, just a month ago, from that apportionment that just got paid, within the last couple of days. So that deferral happened. Didn't cause a lot of concern for any of the LEAs in the state. But what happened next then is when the budget was put together, and the state then said, okay, let's do some more deferrals. Now, they could have cut by $11 billion K-12 spending authority, but they didn't. So that's why it's kind of a double edge here. Is one is it keeps your spending authority $11 billion higher than it would otherwise be, but then it creates cash flow issues because you are now going to have your full year budget, but almost all of that second half of the year is going to be deferred repayment and reimbursement into the next fiscal year. So here's how this works. So starting at budget year 2020, 2021, about $11 billion in deferrals. Those deferrals start in February, and the earlier the deferral, the longer the wait to get paid. So we have another chart to show you kind of in pictures what this looks like, but the February apportionment, almost about half of it then gets deferred until November of next year. The last round of deferrals, they were for a shorter period of time. So the challenge here is you've got your February apportionment, March, April, May, June, July, August, September, October, November. You've got 8 to 9 months to wait for that reimbursement for that February apportionment. The next month, March, it's a higher amount. So you go through March, April, May, June, you're looking at almost 3/4 of your state apportionment being deferred. Now, again, we said, kind of for shorter periods of time, from March to October, from April to September, and so on. But still, what we're looking at here is almost like 40%, 45% of what you're expecting to be reimbursed from the state being put off until the next fiscal year. So it creates real challenges in your cash flow. And we got to tell you, cash absolutely is one of the most important things that you can look at to make sure you're solvent and meeting the needs of your students and your staff. And did I mention to say solvent? Solvent, because it is absolutely critical that you're aware of this. What this means to you is if you're a higher wealth area, you get higher property taxes, but you're still getting a portion of state apportionment. Let's say 10 or 15 or 20% of your revenue comes from the state. This is less of a challenge for you, but still you have to figure out how you're going to finance your expenditures between February and as late as November. But if you're like on average, local educational agencies are getting about half of their revenue from the state. So state apportionments are larger on average. And so this creates even more of a difficulty in trying to finance that dry period. So where you finance this dry period is 1, through budgeting. 2 is you're going to look at your own reserves, and there are different parts of reserves that you can have access to and then pay those reserves back. You can actually spend some of your reserves, but again, you just have to be really, really careful to not use, one-time reserves for ongoing purposes. That's always kind of a rule of thumb. You can potentially look to your county office or your county board of supervisors for some short-term loans, but just know they're under the same pressures that you are. County offices of education, they're working in this area of deferrals. County government has budget cuts because they're experiencing lower local revenues as well. So those are things you have to really think about. And then the next thing we're going to talk about is the other possibility for you to finance this dry period, and that's through the use of tax revenue anticipation notes. We call those TRANs, T-R-A-N-S, tax revenue and anticipation notes. That would allow you then to look at this, set your budget, and then borrow money to cover that period, and then you repay that back as state apportionments come back in. So to now talk about how TRANs work and how CSBA's cash reserve program works, I want to go back now and reintroduce you to Mark Farrell, who will take us through that part of the program. Mark, take it away.
Great, thank you, Dennis. Dennis, do you want to talk about this slide before we jump to the cash flow?
Yes, I did. I was so excited to hear about the TRANs. So I promise this, and thank you, Mark, for pointing this out. What this is we do budget presentations a couple times a year in partners with capital advisors in their budget perspectives workshops. So we just took this from that deck of slides. This shows a picture of how the deferrals work. So this isn't meant to be read top to bottom or bottom to top. It's meant to be read left to right. So the kind of secret deferral that just happened is there on that left edge. So that's, open and close should be done. We're done there. But then as you go to February, you can see February all the way over to November. And those amounts add up as you get through the end of the fiscal year to where you're now almost like $11 billion that then starts getting paid back periodically as you go into the months for the next fiscal year. And so that's absolutely critical to know then about how the financing works. You've got an amount that's growing the last part of the fiscal year, and it's expanding over the last part of the fiscal year for you to then have to finance your cash flow. So now, Mark, I will hand it off to you to explain how the program works.
Great, thanks, Dennis. So we can go ahead and go to the next slide, please. So the program began in 1989, and again, it's designed to pool the issuance of tax and revenue anticipation notes, or TRANs, for school districts, county offices of education, and community college districts throughout the state. And traditionally, the challenge for cash flow for districts tended to be before property taxes arrived in December, and then maybe again before the property tax payment in April. But with the state apportionment coming pretty regularly, those would really be the only two periods where cash was a problem. Now, with, as Dennis talked about, the deferral of so much of apportionment in the last half of the year, districts are going to be facing a situation where cash at the end of the year is now a bigger problem. And so the program will have multiple TRANs this year. We're actually finishing up our TRAN now for the first half of the year for districts that have that cash need before December. And then we'll have kind of another option for TRANs that for districts that need to cover their cash at the end of the year. And one of the big things with the program, there's no cost to apply. There's no obligation to issue. If you take a resolution to the board and approve it, there's no obligation to issue. And so really want to stress the point of thinking about cash flow early, going ahead and taking the resolution to board if you think you might need to, and then you could always stop the process, not issue the TRAN, not incur any costs if your cash situation changes and you don't need to issue the TRAN. So we can go to the next slide. And so wanted to show a little bit of the history of the program. I talked about it started in 1989, and you can see kind of the increases and decreases both in the number of districts and the dollar amount of TRANs that have been issued. The program has gone through several ebbs and flows of state economy and different challenges that the state budgets have placed onto school districts. Over this 30+ year period, we've issued over 6,200 TRANs for individual districts, county offices, and community colleges, over $19.5 billion. And I think one of the most relevant things, given what we're facing now, if you kind of look in that 2010 to 2014 period, we did have a 5-year period where we were issuing TRANs that went across the end of the fiscal year, specifically designed to cover these cash flow deferrals that we had in the Great Recession and that we're now having now. I think we all thought we'd get a little bit longer than 10 years before the legislature reenacted deferrals, but unfortunately we're having to deal with that this year given the pandemic. We can go ahead and go to the next slide. So briefly, kind of what are TRANs? And I think one of the big things is, TRANs are really more like a loan than a line of credit. When you actually issue the TRAN, the cash gets delivered to the district when the TRAN closes. That's not something you have potential authority to draw from only if you need it. So we actually will issue a municipal security, kind of like if you're familiar with the general obligation bonds that many districts are issuing. It's very similar to that process. We actually go out and sell a security to the municipal bond market. And TRANs are subject to various rules, both state law-wise and federal tax law-wise. Typically we're issuing tax-exempt TRANs. The benefit of tax-exempt is the interest the investor earns is exempt from federal income tax. So therefore they have a lower interest rate, typically maybe somewhere between 25 and 35% lower interest rate than a taxable TRAN. And so for a tax-exempt TRAN, the longest term we can have is 13 months. So this is designed to cover a cash flow issue. This isn't designed to cover long-term budget issues or structural budget deficits. It's only used for cash flow. And part of that is ingrained in state law. State law only allows you to pledge revenues from the fiscal year that you issue the TRAN for repayment. So it's very important with these deferrals and how the state did this in the recession and have implemented today in the education code. It kind of very clearly delineates that these dollars for school district purposes are considered from the year that they are deferred from, not the year that you actually receive them. And because of that distinction, we can actually use those as kind of the security for the pledge of the TRAN revenues. And so investors are comfortable with the fact that you can actually use those monies to repay the TRAN. Next slide. And again, determining the TRAN amount is largely based on federal tax law rules. So the IRS requires that a district prepare cash flow and that cash flow justifies the need for the TRAN. So we'll kind of look at your lowest cash balance, and that lowest cash balance has to occur within 6 months of the date that you issue the TRAN. So that affects the timing of when we can actually issue TRANs to cover the deferrals. Since for most districts, the cash low point will probably be on June 30th, then we really can't look at issuing the TRAN until after the first of the year. On top of that low cash point, the IRS says, you can't operate a school district, you couldn't operate any business with zero cash. So you're allowed a little bit of an increment on top of that low cash point that's equal to 5% of your prior year's expenditures. Then we also have to take into consideration any unrestricted funds you have outside the general fund. So you can't, if you have large dollar amounts in Fund 17, the IRS would say, oh, those are unrestricted dollars that you could just have in the general fund. We need to take those into account when we size your TRAN, when we work with your staff to determine the TRAN amount. Next slide. And so a little bit about kind of the TRAN mechanics. Put together what a sample cash flow might look like for a district, kind of the light blue being the cash balance without the TRAN, and then the dark blue being the additional cash that's generated from issuing the TRAN. And so we can see with this district, their cash balance gets pretty low in November, but maybe it's they've got enough other funds that they could temporarily borrow from to get through that point without needing a TRAN. But then as you look at their cash really after February, when the deferrals kick in, you can see those cash balances really decline significantly. They have about a deficit of about $5 million by the time you get to June 30th, and would not have any way to cover those with just internal borrowing. And so here we have the TRAN being issued in February. That kind of immediately provides that additional cash that the district can then use to cover its operations. And while the district has those TRAN proceeds, those are deposited into the county treasurer pool. So they will be earning interest from the county treasurer's pool to offset the interest cost of the TRAN and potentially some of the issuance costs of the TRAN. And so when ultimately you look at what does the TRAN cost a school district, you really have to kind of take a look at that net to see what potential interest earnings there are that are offsetting your borrowing costs. And the TRAN proceeds are then, in this case, available across the end of the fiscal year and into the start of the 21-22 year, as that cash balance is still low and recovering as the deferrals are slowly repaid. And so the repayment schedule for the TRAN will really follow the deferral repayment schedule. And so potentially the district could be using these TRAN proceeds all the way out until October, November, when the final deferrals are repaid from the state. And then ultimately the investors would get paid sometime after November, once the district has kind of been made whole from the state. Next slide. And one of the things that kind of goes into what does a TRAN cost in terms of interest rates and the interest cost side of the TRAN. Rating agencies and investors look at a couple key things. So they look at your cash balances on the repayment dates. And so, until a district's cash balance gets back to positive, we kind of would keep that TRAN outstanding. So it may be the case that for some districts, this TRAN goes all the way out until December, when all the deferrals are repaid and the property taxes come in. For other districts, maybe their cash balances are a little bit stronger and the TRAN doesn't need to go out as long. They look at the other reserves outside of the general funds, so even restricted funds, for example, developer fees or other capital funds that could be temporarily borrowed. Those are looked upon favorably. They look at trends, so they'll look at your cash balance trends, your fund balance trends. Are you deficit spending over a period of time? And those are some things that really districts can manage both from the cash perspective and the budget perspective. So we're going to be faced with challenges not only with cash, but potentially if this economic downturn extends, we're likely to see some budget cuts from the state in future years. And so really managing budget on top of cash flow can really help reduce the borrowing costs for TRANs. The rating agencies and investors look at the accuracy of cash flow projections. So, how close are you able to kind of track to what you're projecting a year ahead? And they do understand, when the state changes things, that can't be held against districts. Interim report status, so positive, qualified, negative status comes into play, as well as your long-term rating. So if you have a rating for, say, your general obligation bonds, the higher your rating there, the better your TRAN interest rates would be. Next slide. So a little bit about the timing and process. So if we're kind of thinking about having a TRAN in place end of February, beginning of March to be able to cover the deferrals, we're really going to start that process here in August and September, where we look at districts' kind of preliminary cash flow projections to come up with what is that maximum amount we might need to finance, so that we can prepare a resolution that districts can take to their boards sometime in that September to December timeframe. There's really about a 3-month kind of lead time to put together the TRAN. So if the board at least adopts the resolution by December, we can have that TRAN in place in February. So then December, January, after first interim, and we can really look at kind of the cash flow after first interim. We'll get the governor's budget proposal in January. Then we can really work with district staff on the cash flow projections, determine the TRAN amount, and be prepared to kind of have that TRAN issued in February or early March. And we kind of talked about on the prior slides, those proceeds would then be available for the district's use for cash flow from February to November. And the repayments in TRANs, we call them set-aside payments. So some of the proceeds are set aside. They're not available for use for cash flow. They still kind of sit in a district fund, but they're earmarked to make the TRAN repayment to investors, which would likely happen sometime after November, so potentially in December. And so every month, let's say 20% or so of the TRAN proceeds might get set aside into this repayment account as the state is making its deferral payments. So that payment schedule will be tied very much to the deferrals. And if we get any federal stimulus and those deferral schedules change, the payment schedule would match that. Next slide. So kind of thinking a little bit about roles and responsibilities for people on this call. I think there's kind of really two key constituencies here. One will be, the board members. And again, we've got about a 3-month lead time to have the TRAN in place. And so ensuring that staff is looking at cash flow and gets that resolution to the board by the end of the calendar year, and the board approves that TRAN, puts the district on kind of a great timeline to participate in the program and to be ready to issue the TRAN in kind of February, March. And then we really work very closely with CBOs, directors of fiscal services, on the nuts and bolts of the TRAN. So again, we'll initially start working with you in August, September, looking at your cash flow after your 45-day budget and coming up with what's that right dollar amount to put on the resolution. And again, that is just a maximum. It's the dollar amount that the board is authorizing staff to potentially issue. We can always issue less than that, but if we kind of realize in January that we need more than what the board approved, we have to go back to the board and try to get them to quickly authorize a larger amount. So we try to tend to stay a little bit, conservative on the high side for that initial resolution that goes to the board. Gather the financial documents, cash flow projections, et cetera. And then again, we work very closely with CBOs and directors to put together cash flow projections that are as accurate as possible with the information that we all have. Next slide. And then kind of a little bit about the program benefits. I think one of the big things, the financing team has been pretty consistent going all the way back to 1989. We have gone through several economic cycles, and most importantly, we've lived through the deferrals of the Great Recession. So we're familiar with the deferrals, how to structure our TRANs around them, how to talk to rating agencies and the investment community about them to make them comfortable with the process and the issues. And so I think for me, that's one of the things that gives me a little bit of comfort this go around. In the Great Recession, this was the first time we were going through this, the first time we were trying to convince investors to actually buy TRANs that were based on these deferred state apportionment payments. So we know we have proven success doing that. So I think much more confidence going into the process now than maybe we did 10 years ago. And then kind of the benefits of the pool are lower costs. So if you look at doing a TRAN on your own, you're probably looking at costs that could be anywhere from 2 to 3 times as high as doing a TRAN through a pool for kind of the average school district. We then try to make the program easier for staff. We have standardized documents, the process with the rating agencies, and the disclosure to the investment community, that official statement that you may be familiar with if you've issued bonds or certificates of participation. That's a very simplified process. We've also set up a dedicated website for our TRAN clients in the program to try to make it easier for getting us the cash flows, the audits, the various documents that we need for the program. Next slide. And although it's a pool, and we benefit from having these large number of districts in the pool, we really individualize it to the needs of specific districts. So even though it's a large pool, we will have what we call series, so different pools, let's say within the pool, where we can group similar districts together. Because what we want to do is make sure that every district is able to get the best possible interest rate that they can. So if you're a district with a stronger credit rating, better cash balances, maybe lots of other kind of restricted reserves, you might have some better characteristics than a district that's a little bit more stressed financially, deficit spending, potentially has a qualified interim report. And so we can set up different groupings to make sure every district gets the best possible interest rate that they can. And then the program has been around for 30 years. We're very much known by investors. I'll typically be on the phone with people like Fidelity, Vanguard, BlackRock, Bank of America, some of the large investors every year that typically look at our program and potentially buy these TRANs from school districts. And kind of on the benefits of scale, again, that size, the fact that we are issuing larger dollar amounts, these investors have to devote time to analyze each district to decide, do I want to buy this TRAN or not? And so having this larger program kind of encourages investors to take a look, because maybe they like districts in Series A but not B, and then they like the districts in Series C. So they've got a couple different options that they can look at in terms of investing their dollars. And then the statewide reach allows us to have larger series. So just because you might be a little bit unique in your county, we can put you in a series with districts from other counties, so that again, that one series is larger and attracts more interest than just issuing a smaller TRAN on your own. And then we really try to individualize the repayments, knowing that every district is different. The percentage of percentage of LCF that you're getting through apportionment and property taxes can have a big impact on what your cash flow looks like at the end of the year and then at the beginning of the year. So there may be districts that don't need the TRAN to go all the way out until November or December when all of the apportionments are repaid. Maybe, by August, your cash flow is back to positive. And so we could set up a TRAN that's repaid much earlier for you than maybe another district. So again, setting this up in a way that's going to be kind of the lowest cost for each individual district in the program. And then lastly, I would say service. So, again, we work very closely with districts on development of the cash flows. We coordinate with the counties, and that ranges from working with County Office of Education for certain issues. There's things that need to go to the County Board of Supervisors, and then working with county treasurers as well on reinvesting the funds in the county pool. So we handle all of that coordination with the county. I guess I would kind of close in saying, again, I encourage you to reach out if you have a cash flow problem or think you might have a cash flow problem. There's no cost to issue, or excuse me, there's no cost to apply, and no obligation to issue once you take the resolution to the board. And so much better to go ahead and start the process and stop than call me a week before we're finishing up the process and it's too late to get you into the program, and then really the option is issuing on your own, which is much more expensive. So I think with that, turn it back to Troy.
Thanks to Mark Farrell and to Dale Scott and company for that thorough explanation of the TRANS program. And also our thanks to Dennis Myers for his comments on the state budget. We'll now move to the question and answer portion of this event. Some people have sent in questions already. Some of them are on completely new topics, and others are touching on topics that we went over briefly during the presentation, but I think it's important to hit some of those main subject areas again to tease out the details and make sure that everyone has understanding. So with that in mind, Dennis, we'll go back to the budget a little bit and revisit some of the timelines you mentioned. One person who's watching today wanted to know specifically, when will we have more certainty about the state budget and its final form.
So I think what the questioner is thinking about is the fact that the state delayed the collection date of personal income taxes to just a couple days ago. Right, they extended from April 15th to July 15th. So the thought is, wow, since the state adopted its budget before it knew what those personal income taxes, the finality of that number was, what's the impact on us? So there could be some potential adjustment to the state general fund, but we're feeling pretty confident about the level of funding for schools. If there was some precipitous drop in personal income taxes, you got to realize the personal income taxes were collected for 2019, so everything was still pre-COVID-19 through December 31 of 2019. There's some differences maybe in some of the corporate income taxes, but nonetheless, that budget's been adopted. The state has options then to look at other parts of the budget, raise revenue. There are several attempts that are going to be made the last month of legislative session to raise revenue, or potentially maybe increase the deferral or something like, push the size of the June or May deferral up by $100 or $200 million. So, I mean, those are potential options. But I just don't know. I'm not counting on those things happening. I think our numbers are pretty solid, but we're going to know here within the next few weeks what the amount of tax collections were to see if that pressure is going to build or not build. So stay tuned. Great question. I wouldn't lose a lot of sleep over that just yet, but really stay tuned. We're going to be looking at it every day and kind of reporting that as are the other organizations as well. Great question.
Another viewer wants to know what the impact will be if the Senate does not pass a relief bill that provides substantial funding for education. How will that impact our budget and consequently what's happening at the school district level?
Again, another great question. So, that one is really talking about more federal stimulus. So we know the House passed another round of stimulus, the HEROES Act, that is pretty much off the table now. So Congress has started talking after, about 6 weeks of not really talking to each other. So we know that the White House, the Republicans, the Democrats all want different things. And that's kind of the best case scenario, is when all the sides want something. And the local government or the school assistance piece is at the top of the Democratic list. So we expect there to be another round of stimulus. But the question is, what if it doesn't happen? In this budget, what we know will happen is there is authority for the administration to reduce the level of deferrals if there's another round of stimulus. So since there's $11 billion of deferrals built into this budget, if the federal government came and said, hey, state of California, we just passed the stimulus money and here's X amount for the state of California, or if they said here's X amount for public education, there is some automatic authority in there for the deferrals to be reduced. Our hope is that the federal government provides enough money to eliminate deferrals and then provide additional money on top of that, either in the current year or set us up for the next fiscal year. But again, that's another one of the stay tunes. But if it doesn't occur, then it's the budget we have right now. If it does occur, then you can see elimination or reduction of some of the deferrals at the outset, and then potentially a little additional assistance.
Thanks, Dennis. That's a lot of talking. I'm going to hit you one more time, and then I'll give you a break, get Mark a little bit more involved here. But just want to group these budget-related questions together. So one viewer wants to know whether there will be any cleanup to the budget language or any amendments or new legislation addressing the hold harmless provision for ADA. This viewer explains, as we've talked about before, that growing districts are hampered or hurt somewhat by hold harmless, since it doesn't recognize the additional amount of students. It's looking at previous year's totals when they had fewer enrollment and less attendance. So is there any plans in the legislature to address that, to give a little more relief or recognize what growing districts are experiencing?
Yeah, there's a handful of issues that need to be cleaned up or addressed, and that's one of them. So as you know, as you already said, there's the ADA hold harmless saying, hey, school districts, county offices, charter schools, we're going to hold you harmless from a drop in your enrollment that may occur when you go back to school in August or September, dating back to your February enrollments of last year. But the way it was written is it did not, it just says everybody's held flat. It does not allow for growing districts. And so, yeah, that's on the list of things to accomplish. It's not a shoe-in absolute, but it is on our list, and a lot of the education coalition community, individual school districts and county offices are pushing. So that is one of the key issues. Another key issue to be addressed is the issue of liability. So right now, Assemblymember O'Donnell has a bill that's been teed up on the Senate side to address liability issues for LEAs. Then there's a handful of other issues, some definition issues and things that we want to get cleaned up when the legislature comes back for the last 5 or 6 weeks of sessions. There's a lot they have to do, but it's all focused and targeted on school district financing through the COVID-19 period. So yeah, it's a possibility, and it's a priority for us and a lot of organizations.
Great. And would that apply to charter schools as well, or just to the traditional public schools?
You know, again, I mean, these are great questions. Maybe, you know, so that will be, you know, part of the issue here is that is you don't want to incentivize families to get upset at their school districts and just go to the charter. So there are things that have to be discussed at what growth means. It's clear for a school district, if you've got houses selling, because there are still districts that are growing. Some of them are growing because they've got houses selling, and they've already put teachers in place and got classrooms going to be reopening. That's real growth versus kind of shifting ADA, you know, between an online charter versus a school district who's doing distance learning. So that has to be worked out. But, you know, from our perspective, is ADA growth is really an issue that should be dealt with, you know, from the school district or county office level, and then we have to kind of figure out a fair way for it to be addressed at the charter level as well.
Great. Thanks for that, Dennis. So we have a couple questions that are more directly related to cash deferrals and cash flow management. One of them involves sort of the order of process. If you are in charge of a school district's financials, what are the criteria you should be going through as you're thinking about borrowing, and what is the order specifically of that criteria? Is inter-fund borrowing, is that the first step, and then maybe you look at a TRANS program, or how does that process, that analysis go? Mark, do you have some thoughts on that?
Take that. I think first and foremost is looking internally. So looking at what sources of inter-fund borrowing that a district can do would be the first pot of money to look at before issuing the TRANs. During the fiscal year, there's more flexibility with potentially tax advances from county treasurers. When you get to the end of the fiscal year, typically that is not available to districts, and so then you're looking at, after inter-fund borrowing, potentially there's ways to borrow from the County Office of Education, and then it would be TRANS after that.
And we have a viewer who's wondering what the typical interest rate is on a TRANS, and how is that determined, or what are the criteria? What rates are people seeing?
Sure. Right now, what we're seeing for TRAN interest rates are, say around 0.3%. And so kind of the good thing about having to do TRANS right now, when what's going on in the economy, interest rates are very, very low. And, again, kind of things that play into that ultimately are kind of the rating that the TRAN gets. So similar to all of us that have credit ratings from the rating agencies, districts, when they issue TRANs, will get a rating from, we typically use Standard & Poor's as the rating agency. And so how strong of a rating the district gets will come into play. And then investors also look at things like, what reserves do school districts have? What kind of cash balances do they have? Other funds outside the general fund, all of those things kind of ultimately come into play. And from there, the differences can be a little bit, smaller orders of magnitude in terms of how much interest rates change. Ratings play the biggest impact, followed by some of those other specific financial issues that a school district might have.
Thanks, very helpful, Mark. We also have a question about the percentage of deferrals, specifically, what is the estimated percentage that school districts should project for deferrals each month going from February through June? Is there some sort of calendar or schedule that they can make out to help determine what the percentage of deferred money should be?
Well, if you look at slide number 6, we do some estimating. So in SB 98, and your staff could look at SB 98, you can read it too, it's online. If you just Google California Senate Bill 98, it's going to go right to that. The schedule is there. So what we did is we just did the math between what the expected amount is of each of these apportionments and then what percentage then these deferrals are. And so, what we said on that slide is the February one is about half of that expected amount is deferred. And then from March, April, May, and June, it's almost 3/4. It's about 70.1% that is deferred into the next fiscal year.
Great. And Dennis mentioned slide 6. So for those of you who are asking or are just wondering and didn't ask, we will provide a copy of these slides. They will be emailed to you. They will also be available on the website along with of this webinar. That should be up in the afternoon on this coming Monday. So if you missed anything, you'll have the chance to go back and take your time to go through and get the information you need. One viewer wants to know, how firm is the deferral repayment schedule? I think they're essentially asking, can we rely that the state will keep its promise about when they're repaying the money, and will the money be repaid in full?
The safety in it is that it is in the law. The unsafety in it is that, I guess law can change. So I don't, Mark, I don't think last time that there was a mispayment, there could be some intra-year deferrals adopted later, but right now the state is committed. It is saving, $10.6 billion in the current year, which is the purpose of the deferrals. So right now, it's in the code, it's scheduled. The state has adopted this schedule based on its cash flow. So right now, it's pretty secure. But I can't remember last time around if anything was delayed or late. I think it was done the same way, where it was in the ed code, this amount is deferred and repaid on this date, and I don't think any of those were missed. So our anticipation is that it's in the law and it's not going to change.
Yeah, I would agree. I think during the recession, I don't believe any of the deferrals were changed once that they were enacted. I think the state understands kind of the importance. There's a benefit for the state for districts to be able to borrow. I mean, they're pushing the borrowing costs onto districts by deferring these dollars. So there's a benefit to the state to set this up in a way that districts can still do trans. But what the state did do to address its own cash flow issues was do an intra-year deferral, move some of the money from, I think, July and August, kind of pushed it back further into the year to help the state with its own cash flow issues. So kind of deferrals on top of deferrals from that perspective, but different fiscal year dollars that they were moving around.
We also have a question about borrowing at the state level. Is there any chance that instead of relying on individual districts to bridge the gap with trans or other cash flow measures, that the state itself would borrow on behalf of districts?
I don't know, Mark, if you've got a different answer, but right now we know of nothing set up at the state level for that. But I don't know if there is something, Mark.
I think at this point, I don't know that there's anything set up for the state to borrow on behalf of districts. But that's, potentially a possibility, but I don't know of anything.
Thanks. We had a follow-up question from someone that asked whether you mentioned that determining a trans amount is based in part on federal IRS rules, and if so, could you elaborate on that?
Sure. So kind of what the IRS rules are all around issuing tax exempt bonds, which gives the school districts the benefit of kind of lower interest costs. Really kind of the key point, kind of get into minutia, but the really key point is that the cash flow projection has to justify the dollar amount of the TRAN that's issued. So, on an easy kind of math, let's say you're showing a deficit on June 30th of $10 million. The IRS says, well, you could issue a $10 million TRAN, plus you could add 5% of your prior year expenditures to that amount. And that would be kind of the IRS maximum amount that a school district could issue, or county office, or CCD.
Great. Someone wants to know if the board approves applying for a TRAN and then later on decides that the TRAN isn't needed. Does the district have to follow through with the funding procedures, or does it not have to follow through with them?
No, the district doesn't have to follow through. Basically, as soon as the district realizes we don't need to issue the TRAN, they can let us know, and we'll just stop that process, and there's no cost to the district.
Okay. It wouldn't be a webinar if we didn't have a specific to basic aid districts. So the next question asks, this is coming from a board member in a basic aid district. Their cash flow issue occurs in November and December. They want to know if they can participate in the pool if the sale is not planned until February.
We actually do have a TRAN that we're working on right now that will be completed about the second week of August. And there are a number of basic aid districts in that program, or in that issuance. If your district isn't in that, reach out and we can see what we can do. We might have a few other districts in a similar situation that missed the timeline for this first TRAN issuance, and we may be able to do something for you.
Okay. This last question, I hope I'm doing it justice. I'm not sure exactly what is being asked, but it says, would a fund that is a community facilities district, Mello-Roos, be used if there was no language in the original CFD to prevent it?
That question I'd have to refer to probably your legal counsel that set up the CFD to really kind of give the opinion on whether those dollars could be used for cash flow borrowing.
Thank you.
There should be flashing lights, when you're asking that question, right, Mark? Like, just be really careful with that.
Yes,
just to reiterate,
I will not give legal advice on this call.
Yes, please contact your legal counsel. We can't say that enough. Someone wants to know whether retirements affect the bigger picture regarding district costs. I guess they're talking about attrition, and is that something that you need to factor into your calculations?
Well, I think that a lot of LEAs look at retirements as a way to reduce costs. So you can have a high-paid staffer retire, and then you can replace the person at a percentage of that salary. Or if you are declining in enrollment and you've got retirements, then you just don't replace those people. So yeah, I mean, that is something you should obviously be looking at and talking with your staff. Certain statutes with the golden handshake requirements, there are incentive programs, but they're governed pretty tightly by the code. But yeah, I mean, that is part of the whole budgeting process that you should be working through. And a lot of LEAs have those discussions throughout the year. And
then another question, more of a follow-up question related to charters, If TRANs are not available to charters, what are some of the other better options for borrowing?
I believe there's a financing program offered through the Charter School Association, is my understanding. But yes, I mean, there's a challenge with, the fundamental difference between, how school districts, are funded and ultimately really what would happen in the case of a charter school becoming insolvent. It's more bankruptcy. The school district becoming insolvent is a state takeover, and so investors tend to be more comfortable with the state takeover aspect, and makes it easier for school districts to issue TRANs to borrow short-term cash than it does, unfortunately, for charter schools.
Thank you. And we have one final question. It's a very broad question directed at you, Mark. And our viewer wants you to tell them about the current and future state of the bond market. That's a big request, but if you could just give your assessment of the vitality of the bond market right now.
Sure. I mean, I think I kind of touched on it about the TRAN interest rate question. I mean, the very good news, both in terms of short term, for borrowing TRANs, or if you're issuing, general obligation bonds today, interest rates are near historic lows. We had a little bit of disruption in the market in March when kind of the different state economies kind of started shutting down. But since then, the municipal market has really come back very strongly. Interest rates are low across the board, from short-term rates to long-term rates, and those kind of long-term rates being low kind of tend to signal that investors think rates are going to stay lower for longer. Not going to be a lot of growth, not a lot of inflation. So at least where we're sitting today, kind of a very good time to be issuing debt if you have to be.
All right, and that's a good summary. That brings us to the end of today's presentations. Thank you, Mark, and thank you, Dennis. If you would just stay with us for one further moment, we're going to talk about how you can get the information that we presented today, as well as a wealth of other information related to COVID generally, and then its impacts on schools, whether that's academic, whether it involves community engagement, whether it involves legal issues, finance, what have you. You can get all that information on our webpage dedicated to coronavirus and related issues. That's csba.org/coronavirus. You see at the bottom of the screen, the URL is listed there. And we will post the video of this event. And you can also see all our previous webinars and other videos that CSBA has created at our dedicated YouTube channel. That's youtube.com. You just go to YouTube and then /CSBA videos. We hope you'll take a moment to look at some of the wealth of resources we have there. Next slide, please. We also hope you'll join us for an upcoming webinar. We have a legal webinar on July 29th at 11 a.m. dedicated to legal issues around the reopening and possibly, depending on how the virus progresses, the closing of public schools, and talk about some of the information that was offered today in the governor's guidance, which kind of changed the entire landscape around school reopening. So there's a lot to dissect there. Our last legal webinar was very popular, so we hope you'll join us on July 29th at 11 a.m. for our second installment. That's all we have today, so thank you for joining us. Again, we will be emailing a copy of the PowerPoint presentation as well as a link to the webinar, and that will be posted on our website Monday afternoon. In the meantime, if you have any questions, you can always contact us at csba@csba.org. Thanks so much for your time. We hope to see you soon. Goodbye.